Hi, welcome to Series 5 of the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome to the first episode of Series 5, Jerry Butcher, Workplace Savings Director at Scottish Widows. Welcome to the show, Jerry.
Thank you very much, Charlotte. Delighted to be here.
And do tell us, what is your news story of the week?
So, Charlotte, I've selected an FT article around the FCA's plans to implement a four-point traffic light system to show value for money for pension fund performance. And I've chosen this because I think it's highly topical at the moment. It's obviously kind of value for money is really at the beating heart of, I guess, what the government and the regulators are trying to achieve with our pension system. And I'm sure we're going to get into lots of interesting discussion as to the implications of that.
Yeah, I mean, sometimes it's a bit difficult to keep up because there does seem to be a new consultation on pension schemes. It feels like every week, but we're always delighted when the government times it in time for the brand new edition of a new series of the Professional Investment Podcast.
Very timely.
Very timely. So, as you said, value for money is at the heart of pension provision, and it's part of the pension schemes bill. Was there anything in particular that caught your eye about this new consultation on the value for money framework?
Yes, I think so. Value for money as a concept has obviously been around for a while now. I'd say. I mean, this caught my eye. This is a topic catches my eye, I should say, because we're great supporters of, I guess, what the government and the regulatory sort of regimes are trying to achieve through value for money. We're big believers in value, not just price. And I think in terms of the new nuances to the way that the FCA is proposing to approach this, that they're consulting on, are largely welcome from our perspective. I think there were a couple of things in particular that stood out. The first is, as the FT headline suggested, a sort of 4-point traffic light system for providers. I think that's a good thing. The 3-light system that was previously proposed felt a little bit blunt in terms of, if you're red or amber, there's actually some really quite drastic consequences. And so you absolutely have to make sure that you're green. This feels a little bit more nuanced than that. I mean, still, if you're red, you have to wind up and transfer your business elsewhere. So the ramifications of ultimately not being green are still, I guess, duly serious. But it just feels a little bit less blunt and a bit more practical in terms of providers managing their business and trying to ensure they're green, but accepting that from time to time there's some work to do to remedy things that might not have turned out quite as you hoped. So I think that was probably the first thing, and then the second thing was from an investment point of view, starting to introduce more of a focus on forward-looking modelling of investment returns. As well as the backward-looking stuff, and I think again that's a good thing. We already do model the forward-looking performance of our defaults, and we design our defaults in that sense. I think a good provider ought to be doing that. So we were pleased to see that, and then I think probably just to balance that, what was downplayed a little bit in the consultation, or felt like it was being downplayed a little bit, was some of the emphasis on actually away from investments on the service and engagement side of things. And, we do see those as important components of value.
So if you were to slip from, say, the strongest green to amber, I mean, do you have a period of which you're allowed to recover before the consequences really befall you? And let's imagine that we have another situation where, we know that most pension providers are very heavily focused on equities. Let's say we have, a massive market correction. Is there going to be some leeway in those circumstances?
Yeah, so I think it's Firstly, it's one needs to look at value, and I think one of the aspects is that IGCs and trustees are going to have to form judgments around these things, which puts considerable onus on them to look at the numbers, but also interpret the kind of wider context. But from an AMBER point of view, yes, it's kind of like a 3-year period, and let's take obviously equity markets can go up and down over 3 years, so some of that might be the design of your default, but some of it might just be the broader market. But if I was just to take a service slip up as an example, I would fully expect that if we had a service issue that was causing us to be rated amber, that's enough time for me to make sure that I do something about that.
Okay, and so what do you think the implications are for the pension providers? You touched on some of it there, but could you flesh that out a bit more?
Well, I do think probably the first thing, and it's been the case for a while, but it remains the case, is this is a significant data collation exercise. And, I think for ourselves, we do a lot of value for money work already with our IGC, with our trustees. That there will be some incremental data that we're going to need to source. We're going to need to build that. I wouldn't underestimate that if you're a smaller provider or occupational scheme. That is pretty significant, and so particularly for those small occupational schemes, I think that's something for trustees to consider quite carefully. I do think, as I've mentioned, the shift away from a 3-light system to a 4-light system is helpful, because the more drastic you make the consequences, the more kind of cliff edge, the more likely you are to get providers all sort of huddling around the same approach and the same strategies, because no one wants to be the outlier. So I think it is helpful, but again, it does then place an onus on IGC members, trustees, to form judgments about, well, why did you design your investment default in that way and not in that way, and you stuck your neck above the parapet in a sense and did something different. So it's going to be interesting to see how that plays out. And then I think from a very practical sense, I'm sure we're going to come on and talk about private markets in due course, but how the value versus price dynamic plays out in the market is going to be really interesting, because I think value for money is a useful tool in prodding us in that direction of, look, as a market, as a whole ecosystem, you need to be thinking about value. But in practice, we still see price as a very significant driver. When we are in discussions with schemes for new business, yes, it's the whole proposition. But I wouldn't think it's often that a considerably more expensive provider prevails. We are always asked to go that extra basis point to try and win. And so I think it's actually going to be really interesting whether the market as a whole can manage that shift away from price and towards value.
Yeah, and you've touched on a really interesting point there, because the government kind of, as we've mentioned before, got this pension schemes bill, which has masses and masses of stuff in it, not just DC, obviously. But one of the things that they're also trying to do is really sort of consolidate the DC sector, and wanting master trusts to only have a minimum number of assets of 25 billion. And that kind of runs in contradiction to value for money, because if you're forcing every scheme to be 25 billion by a deadline, then they're going to be doing everything they can to pick up market share. And that usually means competing on price. So I think it's going to be interesting to watch. And I'm very glad I'm not the one who has to manage this particular competing desires of how do you kind of bridge the value for money drive with the, I have to be big enough drive. I mean, if you're big enough, if you're already over 25 billion, then you can kind of relax and focus on the value for money, maybe. Do you think that's going to be interesting to see how it plays out? Do you think maybe it should be something that tackled in stages, consolidation first and then value for money? Or do you think that's naturally just what's going to happen?
I think, it adds an interesting factor into the overall kind of competitive mix. So yes, absolutely. If I was a smaller provider who thought I had a realistic chance of getting to 25 billion, but actually things do need to go right. I do need to land my new business plan. Then yes, I would be pulling every single price lever I had available. Obviously, as part of an overall proposition, but I wouldn't want to be missing 25 billion because I didn't offer that extra bit. So I think the two are to a degree in competition with each other. I mean, I would say, this is a business where scale players can leverage a fixed element of their cost base to pass on more value to members. So I think in the long run, consolidation, as long as it doesn't go too far and you end up with sort of oligopolistic behaviour or monopolistic behaviour in the extreme, it should be conducive to large, efficient providers being able to both operate at low cost, but also deliver a rich suite of services and a rich investment proposition. But I think you're right that the transition is a bit messy, and that's on top of, as I've said, the dynamics we already see in the market, where if you're an advisor, I completely understand you want to show you're getting value. You're getting a good price for your client as part of that broader suite of value.
Yeah, and we are the professional investment podcast, so let's narrow it down a bit more and think about what do we mean for value for money when we're talking about from investment perspective. How do we generate the best investment value for scheme members?
So that's a interesting question, Charlotte, and I think it is one of the reasons why that article piqued my interest, and I think there was another article in there at the same time around flows into domestic economies and so on. I mean, I think from my perspective, we have to put the member first, and we have to design the investment proposition that we believe will deliver the best outcomes for members in terms of risk-adjusted returns, and those risk-adjusted returns need to take into account, fees and charges. So I guess that, what that means to me is I should be very happy paying more for an asset class that is additive to my kind of risk-adjusted returns. But obviously, I am stating the very obvious here. If it's dilutive, then I wouldn't want to do that. So I think it can be a bit simplistic to say, value equates to paying more for investment management. I mean, I think it depends. It depends where you come out on the kind of passive versus active debate. For example, I mean, I think most providers in the market have a predominantly passive approach, and that's kind of underpinned by lots of research and theory in large liquid active markets. Now, clearly, if you look at venture capital, for example, it's totally different. So, the same principles apply in terms of am I adding something to my investment mix that's additive to risk-adjusted returns? But the execution of that is different. The fee levels are very different. And we should be relaxed about that, as long as we're holding the kind of member outcomes at the forefront.
Yeah, and I mean, the point about investment is it's not, a set and forget thing. It's something that you have to constantly reassess and look at. I mean, you mentioned passive there and active, but interestingly enough, there are actually a few pension schemes who have taken on active equity strategies, ones that you wouldn't even expect, because they're concerned about the concentration risk of the US tech sector within the large global indices. So that is the point, isn't it? It's never something you can just go, I mean, in a way, you should I remember the great story I was told years and years ago is the best performing fund, and this was from a wealth perspective, was a family that hated each other so much that they could never come to a decision. And as a result, they had left their portfolio completely untouched for, I think, decades, and it was the best performing portfolio. So in a way, yes, you should do that. But you also do need to respond to what's going in the marketplace, and you need to think, am I building up too much risk there? Can I afford to take that? and new asset classes might emerge, or we have things like global financial crisis that profoundly shift, for example, the way banks do loans and make it possible for asset managers and pension providers to start loaning money to business. So it's a sort of constantly moving game. But in theory, I guess, with the benefit of hindsight, you could always find the perfect portfolio for any one moment in time, couldn't you?
Well, absolutely. And I agree with your point, Charlotte. I mean, I think, if you look at what's going on in the wider macroeconomy, I'm still an optimist. I believe that we will end up, after a period of turbulence, still competing in a global economy for capital market flows. I'm really hoping that we don't end up as these kind of regional blocks. But if we do, well, that's a very different model to how we're set up today, and we would need to evolve to reflect that. And your point around exposure to sort of systematically important, index managers is a very good one. And that's not a pure, can I see this in my investment returns today, and can I put this into a model and show how my decisions around allocating to a particular manager affect my returns for the next 10 years. But it is a relevant factor for me as a manager of a business, in terms of trying to, sort of think about the broader operational risks, and so on. So I totally agree. It's not a kind of like one size fits all forever.
So we've kind of like danced around it a bit, but can we let's talk a bit about the role of private markets, and we'll also sort of talk about that other Mary McDougall story that you mentioned. So what role should private assets be playing in a pension portfolio, and what are the rules that you should have for yay or nay?
So we are building. Well, sorry, I'd say that we have built actually our private markets proposition, and it will be available for clients from the end of January onwards, and I'm really excited about that. And we are, and I am a believer in accessing private markets because of that extra diversification that it enables you to achieve, both within sectors, but also looking at different sectors that you might otherwise not be able to access. So VC in a kind of listed sense is obviously very, very, very difficult. So I'm really positive about having private markets as part of our armory. That said, we need to look at it objectively, on the same basis that I referred to earlier. So, is this additive to member returns or not? And there will be good managers, there will be bad managers. There will be times of the cycle when a particular private asset class is valued sensibly, and there'll be other times where it might seem a little bit puffy in terms of valuation. So, as you've referred to previously, it's very context dependent whether private markets are a good thing or a bad thing. What I would say is, as a pension provider, I think it's absolutely fundamental that we put in place really strong governance around accessing private markets. There's new risks here that are not prevalent in the listed market. And so we need to be really clear that we have got the right governance and the right alignment of interest with the managers that we're using to make sure that we deploy this safely. What I'm really keen, I guess, overall to get away from is a kind of automatic association between the concept of value and the concept of private market investing, because they're not, one does not always equal, it's not kind of like a mathematical this equals that. Yes, I think it's positive overall. It's how you deploy it that is going to be really important.
Yeah, I think that's right. And we've alluded to it, but let's flush it out to the open. There's another piece in the FT this week, a big article by Mary McDougall, where she talked about how schemes around the world are sort of fighting and get back against government, saying, no, we are not your golden goose to be able to exploit to get yourself out of an economic growth hole. So have you got any thoughts on that? I mean, whilst we there's private assets, there's investing in the local economy. There are plenty of countries that do already invest in the local economy. Australia famously started out by only investing in Australian equities. How do you think that should develop over time? How statist should we be about that?
So I'm pretty cautious about being statist, and I think that's where this really, does this pass the acid test of, is it going to deliver value for members? So I want the ability for us to allocate across asset classes to deliver the best possible member outcomes, and I believe in the market as the kind of, okay, markets are imperfect, we know that, but in my view, it is better than a kind of state-directed capitalism. That has been tried in different formats in the past and can result in significant misallocation of capital. So I kind of inherently am more of a believer in the market, and lots of pension providers and lots of other actors in the capital markets all having a view, and in aggregate you come up with, well, what's the price for this asset, or what's the kind of demand to put capital into that sector. So I would be very wary of a kind of state-led capitalist form of capitalism. Having said all of that, I am very supportive of obviously what the government's trying to do to attract investment into this country. I think they should be attracting investment from Australia, Canada, our European peers, Japan, as well as from UK pension providers. And I think if they can set the right conditions, then capital will follow. I don't think it should matter as an economy where that capital comes from. And I do think that we, our peers in Japan, our peers in Canada, ought to be diversifying, and spreading our risks. So, yes, we kind of, as you and your listeners may be aware, we as Scottish Widows, we didn't sign up to manage the house. That doesn't mean we don't support what the government's trying to do to drive growth. Driving growth in the economy will drive better member outcomes as well. More successful businesses able to pay higher contributions, higher wages. We're very supportive of that. We just don't believe in a kind of state dictated, listen, you need to be putting capital into here.
Yeah, I mean, it could come back to bite them as well. If you're forced to invest in something, then it turns out not to be such a great investment, and you've left another investment off the table, so to speak. So I would be wary of that too. Do you presumably already invest in the UK? Is that fair to say? Scottish Widows does.
We're big investors in the UK across Lloyds Banking Group. So we're owned by Lloyds Banking Group. We are huge investors in the UK. So whether that's from a commercial real estate perspective, social housing, we run big annuity portfolios that are very weighted towards UK credit assets. So in aggregate, we are very big supporters of the UK economy, and we're proud of that, and we'll continue to do that. But that's kind of by choice and so on, either because as a shareholder, we think that's the way to get the right returns on our shareholders' investments, or from a customer perspective, because we've got their outcomes at the forefront, and we're trying to drive to deliver them the best return possible.
Yeah, and I mean, some of it is also about risk, about matching risk to your liability risk as well. That's why insurers love global credit for that as well. We've talked a lot about investment, which is great because we are the professional investment podcast. But one of the things that you and I in another forum have discussed is that for a scheme member, at the end of the day, if their investment portfolio performed really badly, they'd be upset about that. But there are more tangible definitions of value for money for a scheme member. And you mentioned service levels and engagement. Let's just touch on that. What do you think that scheme members really want? Do you think the government's reflecting that accurately in this framework as well?
Well, I think that's my slight concern is I think we see a little bit of a stepping back from those components of value, not a complete stepping back, but we wouldn't want those to be missed out whilst there's a very clear and understandable focus on investment. So look, at the end of the day, obviously, value for members is delivering them the best possible return on their savings, such that they can secure, hopefully, the retirement income that matches their kind of aspirations and so on and so forth. So the investment component in that is really important, but so are things like contribution levels, making the right decisions at retirement around not doing something silly from a sort of personal tax liability perspective, and I wouldn't want to kind of like miss out on the psychological value of, well, look, when I wanted to claim my money, it was easy to do. There was no hassles, no delays, and I've got confidence that if I want to go back to my pension provider in future, I can access my funds really, really easily. Now, if you don't have that, then you see some of the behaviour that we experienced in the lead up to the budget, as an example, where people start to get a little bit nervous about the system, and then they take their money out and then park it in a bank in cash, and that's obviously not always the best thing for a customer to do. So I think these other components of value are really, really important. And as I mentioned, I think we would be quite concerned if they were deprioritized, because I think they are. That they're like, what's the weighting between investment, service, engagement? That's a judgment each of us will have. Investment is really, really important, but these components are really important too.
Yeah. I mean, I'm wondering as well, when reflecting on that, you touched on retirement income. We haven't talked about that today, but, we talked about that a lot, and I'm sure we will in the future. Is there any sort of sense at the moment this value for money framework is also going to be provided? And I know this isn't going to happen now because we're so nascent, not just to the growth phase of the wealth, but also the spending phase of the wealth, to the retirement income portion of the journey as well.
So, Charlotte, I'm not actually aware of the answer to that. So I need to check with my team. I could see that it would quite naturally be extended, because that's it. I mean, it is as important, isn't it? We know that we're going to have, and we do have, customers who arrive at retirement who haven't quite got the pots that they need to support their retirement lifestyle. And trying to find the right balance between growth and de-risking is a real challenge for all providers. And there's a lot of interest in the market about what the right kind of solution set would be right now, whether it's collective defined contribution or some kind of hybrid product. Actually, I think this is one of the most exciting parts of the industry, and one of the areas where we do have some work to get this right. But I would, just speaking personally, not aware of the FCA or the government's plans. I would see it as a natural extension to then go and look at those retirement solutions and say, well, are they delivering too?
Great. Well, I think that's a great point for us to end our discussion. Thank you so much, Ray, for sharing your news story of the week and for all of those insights and expertise. It's been great having you on the show, and it's good to be back in the podcasting chair again in early January. Listeners, if you want to never miss an episode of the podcast, make sure you hit the subscribe button, and do make sure that you engage with the podcast. If you're listening on Spotify, take part in the poll, and thank you so much for listening.